Hey everyone, welcome back to Finance Sphere. The crypto market has been chopping sideways lately, giving us some relatively quiet price action. Today, we aren't talking about day to day price movements. We are laying out a concrete, step by step game plan to understand why traditional finance giants like Visa, MasterCard, BlackRock, and JPMorgan are allocating significant capital to the crypto space. Out of all the stablecoins in circulation right now, less than 1% are actually being used for real world payments. The remaining 99% are sitting dormant in people's wallets. It appears to be a ghost town. So, why are these major financial institutions investing so heavily to build payment networks on what currently looks like an empty highway? Here's where things get interesting. Their ultimate customer isn't necessarily human, it's AI. Major tech companies, Google, Microsoft, OpenAI, are steadily rolling out AI agents designed to navigate apps and execute tasks on our behalf. We're moving past the era of simply prompting an AI for a text response. AI is evolving into a new operating system that autonomously plans and executes tasks from start to finish. Gartner, a global IT research firm, stresses that we are entering the era of machine customers, autonomous AI devices engaging in economic activities instead of humans. As AI evolves, it will analyze situations, select optimal conditions, and eventually negotiate and transact directly with suppliers completely on its own. Gartner predicts this will be a highly disruptive business trend over the next decade. We're looking at a future where, without you lifting a finger, your AI will draft your weekend marketing report, analyze internal company data, figure out your commute, and book an Uber exactly when you need it. This is a significant paradigm shift because the AI itself becomes a primary consumer. Right now, we pay for things using credit cards linked to our phones. But when an autonomous EV needs to purchase electricity from a private charging station, or an AI needs to pay a toll or access a premium database, it's going to need its own mechanism to make autonomous payments. Robots and AIs don't have legal personhood. They can't open a bank account or get a standard credit card. Under the current legacy system, a human has to sit there and hit approve for every transaction. If an AI agent makes microtransactions every second to access paid services, you're looking at an endless stream of approval requests. You also can't just hand over the keys to a corporate billing system to a bot. And traditional banking networks that shut down on weekends simply don't work for AI. This is exactly why traditional financial institutions are investing heavily in infrastructure that, at first glance, appears underutilized. Balaji Srinivasan, former CTO of Coinbase and ex Stanford professor, explained the convergence of AI and crypto perfectly. AI decentralizes intelligence, and crypto decentralizes assets and trust. Blockchains make no distinction between humans and machines. As long as an entity can generate and control a private key, it can create and operate a wallet. Because crypto is programmable money, once the conditions of a smart contract are met, the code executes the transaction automatically. Transaction costs can be dramatically reduced with near instant settlement available 24/7. In a digital landscape increasingly populated by AI and bots, crypto's cryptographic verification provides a necessary trust layer. Ultimately, building infrastructure in the crypto space today is about establishing an early competitive advantage in the operating systems of the future. The key question is, if crypto becomes this underlying infrastructure, where should capital be deployed? To answer that, let's break down how AI and robots will actually spend money into four distinct stages. Stage one, the crypto layer. Every autonomous transaction begins with a digital asset that can function as programmable money. This operates on a decentralized blockchain where data recorded on chain becomes immutable. Stage two, the network and tokenization. Enterprises need reliable blockchains with decentralized ecosystems to host their data and tokenize traditional assets like stocks, bonds, and real estate. BlackRock CEO Larry Fink called RWA tokenization the next generation for markets and securities. When investors have a tokenized identity and trade tokenized securities, settlement becomes instantaneous, streamlining the process and reducing middlemen. Once data is on chain, AI can seamlessly interact with it. Stage 3: KYA, KYM, and security. When AIS process millions of transactions, robust verification is required. Traditional forms of identity verification will increasingly be supplemented by cloud-based digital identity systems. Furthermore, smart contracts rely on oracles to securely fetch and verify off-chain data. Think of oracles as the data traffic lights connecting the real world to the blockchain. This intersection of cybersecurity, AI security solutions, and crypto oracles is positioned for substantial long-term growth. Stage 4: Fiat settlement. Ultimately, digital transactions often need to be settled in fiat currency. TradFi institutions are actively deploying capital here to manage this gateway. They are building tokenized networks and settlement systems to capture transaction fees at the final fiat off-ramp, which includes global payment networks, exchanges, RWA projects, and institutional DeFi platforms. This isn't science fiction. It's a developing macroeconomic shift. In the past, crypto lived in a legal gray area, keeping conservative institutions at bay. But that's changing. Starting with Europe's MiCA regulation and moving to global financial hubs like Japan and Hong Kong, regulators are granting stablecoin issuance and custody licenses to traditional banks. Even the US Congress is debating stablecoin bills to establish clear regulatory frameworks. While much of the current market liquidity is flowing into the AI sector, the narrative that crypto is being left behind is a superficial read of short-term trends. AI and crypto aren't competing. They are two interconnected technologies driving a multi-year trend in the future economy. Today, we shifted our focus from timing the market bottom to examining the strategies of global financial institutions. These institutions are investing today because they expect digital infrastructure to become a core part of the future financial system. By identifying the key players in this long-term transformation, you can better understand where long-term opportunities may emerge. That's a wrap for today's video. Thanks for watching, and I'll catch you in the next one.